no music.
I'm dancing in my head,
No,
bro.
there's nothing playing.
Thank you for tuning in to another world-famous episode of the #1 financial literacy podcast, The Higher Standard.
Thank you for recognizing.
Game recognized game, brother.
Yeah. Gang, gang.
Gang, gang.
Wow, we pounded it.
We did. I love pounding it.
Yeah, I know you do. That's why I gave it to you.
If you were watching this on YouTube, and I recommend that you do, you're going to see we've made some upgrades.
A little bit.
Studio has gone from cocoa sexy and slightly off in lighting to what I like to call rock star shit.
I feel like I'm being interrogated.
There are a lot of lights in here.
Yeah.
But in our ever continuing pursuit of greatness, we've decided to make some upgrades. We were not happy with the video quality production that came out, and now hopefully we'll get there. The next thing on the agenda will be the audio, getting the audio and the video podcast up to what you guys are used to hearing whenever you tune in on all the streaming platforms like Apple and Spotify.
Yeah, and those are the platforms that you should have left an honest 5-star review on.
And if you haven't, it's okay. Just go ahead and roll on over to YouTube, subscribe, and then leave your honest 5-star review on the streaming platforms.
Do you think people notice that we comment and reply to each comment?
I think by we, you mean me.
So you haven't noticed.
I haven't noticed that you haven't noticed that you're not doing it. Yeah. Can we get to the show?
Yeah.
All right. So we're going to hit some high points this week and try to get through as much of a massive amount of information as possible. This is a really good pivotal week in the economy because what we're seeing here is a pivot from, I think, a banking focus now to debt ceiling focus. But there's also some things happening internationally which are really, really important. We're going to talk about Argentina.
Man.
Shit's going down. Yeah.
Shit's hitting the fan.
Shit is hitting the fan indeed. Then we're going to talk about consumer debt, obviously passing a notable milestone. And what this might mean for you. In the interim time, while all of us were freaking out about what was going on in the banking sector, some savvy investors think Michael Burry and Warren Buffett were buying up on the low. Like we've always said on the show multiple times, that even though some of this news is bad, it does not mean that it is not a good opportunity to make money. You just have to be willing to go against the grain at the right time.
Absolutely.
Then we'll round out the show with some of our usual segments. Saied loves trashing crypto, so we're going to go ahead and dabble into a little bit of that. We'll talk a little bit about how U.S. households show signs of stress as new delinquencies rise. And then maybe Saied and I will sing a cappella at the end. Will we do it? You'll have to tune in and see.
What? This is news to me.
You're going to be singing. I'm just going to be laughing at you.
Got you.
Yeah.
Let's go.
So let's kick things off with a question that I think Saied and I get a lot. I mean, how many times do you get people DMing you or messaging you saying, hey, man, do you have a good book to recommend on all this stuff I don't really understand?
Yeah, all the time. It happens literally all the time. And Chris here put down some good recommendations. So I actually know the first one. I didn't know the other two.
Your vibe is off tonight, dude. Vibe check.
Dude.
Your vibe is off. What's going on with you? You want to talk about it on the show? Let's go.
I'm being interrogated with all these lights.
The lights throwing you off?
If only people could see. Actually, I'm going to post it on the story so people can see.
Well, the lights don't bother me as much. It's all like the mess that we got going on here because we went from like a clean, flawless studio to like just fucking wires everywhere, man.
Wire management is a little...
Yeah, we're going to have to fix this.
Yeah, it's a little sus.
This is a fire hazard. But hopefully it looks good. So, there you go.
Right.
All right, so book number 1, The Federal Reserve, What Everyone Needs to Know by Stephen H. Axelrod. This book is spectacular for a number of reasons. It gives you kind of the baseline of how the Federal Reserve System is supposed to work and a little bit of history in how things got to why they work that way.
Right.
It doesn't go through, obviously, what's going on today, but it gives you enough of a background for you to go, okay, so this is how it's supposed to work. Is it really working that way?
Right, and what their function is, right?
What their function is. So, and the reason why this is important for those of you who might be going, okay, well, why the hell do I care? A lot of people might have a degree in economics or a degree in accounting, but they don't necessarily understand how the Federal Reserve specifically is supposed to work in the history of how we got there.
Absolutely.
So the second one that I'm going to recommend is Modern Money Mechanics. This is a workbook, believe it or not like when you were in school and you had to take it home and get crayons and color with mommy and daddy, although Said's been doing a lot of that lately.
My favorite. Yeah, kids, exactly. They're at that age.
This one is the actually published by the Federal Reserve Bank of Chicago themselves. They offer it in paperback. I think there was an audiobook at one point in time. But, yeah, great book.
Paperback, only $11.50 on Amazon.
Yeah, not bad.
Steal.
See, we're trying to think of everyone here.
Right,
okay?
absolutely.
We're not just throwing out big dollar books.
Mm-hmm.
Smaller dollar books, too.
And Kindle, too. By the way, you ever been a fan of a Kindle?
No.
Yeah,
I tried reading off my mom's once. Just not good for me.
No.
Although I have read on an iPad.
Mm.
It's weird. So the third book, which was actually not my recommendation, I actually saw this on of all pages on Ballerbuster's page. I took a screenshot of it because I wanted to read it, and I ultimately wound up reading it. And I thought it was so super important for what's happening today.
Mm-hmm.
And their comment on this was nobody's going to read this, but nerds like me.
Yeah.
And I thought, okay, well, I'm a nerd. I'm going to read it too.
Yeah.
It's called The Volcker Rule. The Volcker Rule. Sorry.
Yeah.
It's
referencing former Fed Secretary.
Yeah, Paul Volcker.
Paul Volcker.
Commentary and analysis. So basically his commentary and analysis on the rules that he put in place. Obviously, Paul Volcker being very, very famous for causing the double dip recession in the 80s.
Right.
And is a huge influence on Jerome Powell.
Right. And hopefully, this isn't so economically friendly. Paperback, $200.
Okay, well, it wasn't my recommendation.
No.
Okay, so
No, but you're recommending it now.
Yeah, I'm recommending it now because it's a good book.
Yeah.
But I should say I got this on audiobook and it was way easier to read. Like Ray Dalio's Principles.
Right.
I could never. Have you ever seen how big that book is?
No.
It is fucking massive.
Really?
Yeah, it's intimidating. But I got it on an audiobook and I listened to it over the course of like a year and a half.
Yeah, yeah.
I'm not overstating. It's a long book.
Given the time that we're in now and how Fed Secretary Jerome Powell is constantly citing Paul Volcker, definitely worth a listen or read.
Yeah, if you had to read any one of these three books and you said, Chris, which one do I read? Read the first one.
Yeah.
Read about how the Federal Reserve System is supposed to work. I think that one's going to be...
Or listen to the Higher Standard podcast.
Yeah, and you know what? Stephen H. Axelrod might be a published author, might be an economist, whatever, but they're not Nobel Prize-winning laureates to be like Saied is.
Right.
Yeah.
Maybe someday.
When you grow up?
Yeah. No, him. Stephen H.
Axelrod?
Axelrod.
He's not worth you remembering his
What
name.
a name. Axelrod.
Started off early tonight, huh? we going right into it? It just
some of them are meant just for you, bro.
I just want you to know.
You don't got to point out every single one.
You don't have the deposition threats that I do. Like when people actually write this stuff out and then ask you to read it back in like a courtroom setting, it's very awkward.
No, he meant what you thought he meant. Yeah.
Mr. Hebe, did you realize that he was referencing a male organ when he said that? No. Oh my God. He was what?
Why would you think that?
Why was he doing that?
No.
I have to rethink my entire relationship with a man now. Like rethinking your entire currency.
Oh, decent segue.
I thought it was pretty good.
Yeah.
So in Argentina, according to Bloomberg, things have gone from bad to worse.
I had no idea that this was going on, by the way.
Oh, I knew it was bad. Didn't they switch? Arun can look this up while we're talking about it. But I think they switched at one point in time. They tried like the Bitcoin pivot.
No, that was El Salvador.
El Salvador? Okay, who cares?
Wow.
Wow. Shots fired. No, but Argentina, okay, so the monetary authority in Argentina will raise its benchmark rate by 600 basis points.
For the record, we've increased it 525 basis points.
Yeah, they're doing it at a single time.
Yeah.
600 points. Like, hey, guys, guess what? In June,
you
know what? I think instead of holding rates in the United States, we're going to go up 600%.
Yeah. Why mess around with this little stuff, 25, 50, 75? Let's just go straight.
Let's nickel and dime it. So I guess the natural question is, why the hell would they do this? Well, they're going up 600 basis points to 97% on Monday while boosting intervention in the foreign exchange market, the officials said, asking not to be named before measures are formally announced by the economy's minister, Sergio Massa.
Right.
So
this is all happening because why?
Well, because they have inflation problems. Massive inflation problems.
I feel like inflation problems is an understatement.
Well, inflation sped up to 109% as currency weakens before the election. So that sounds shockingly familiar.
Yeah.
Like in the United States, in November of 24, we will have an election. And when we do, this all financial, the whole financial climate, economic policy that led us here, inflation, how the Fed has handled things, these will all be fodder, and you will hear it all over the election commentary.
Right. And this actually led me down like a dark rabbit hole because I had to look up who else, is experiencing inflation in food to this magnitude. Apparently, Lebanon, 350%.
Wow.
Year over year.
That's crazy.
That's fucking. I mean, so people are surviving off of they're calling them soup banks, so they're just eating soup to get by. It's fucking depressing, man.
There's so much culture that you were unaware of when you made that statement.
Yeah.
That it's I almost feel bad for you.
What do you mean?
Bro, it's Lebanon, man. It's they've had tremendous poverty there. There's been
No, but
fighting for
no, I get
decades.
it. No, that I know, but they've also had plenty of good times too, and I actually know people that would travel there on the summers.
To Lebanon?
Yeah,
It's got to be expensive as hell now.
Apparently, they had at one point in time like a great nightlife and everything. But their president Alberto Fernandez, I thought this was worth mentioning.
In Lebanon?
No, in Argentina.
See, if I didn't clarify that for you,
Yeah,
you would look like you were talking about Alberto Fernandez as Lebanon's president.
no. So apparently, he came out recently the other day and was like, "By the way, guys, this problem that we're going through right now, yeah, I won't be running for re-election."
Good call, Alberto.
Yeah,
Yeah.
They went to the vice president. Yeah, no, me neither.
Also a good call. Yeah.
Opposing party.
You know what's interesting?
Lead candidate for the opposing party. Yeah, me too. I'm not.
When was the last time you saw our vice president? That's not a political statement.
Who that?
I'm just saying, like, Kamala Harris.
Oh,
I think last time I may have seen her in public was when she got elected.
I feel like the only times I have seen her are like on those late night talk shows.
I haven't seen her late night talk show, but are you up late often like that? I don't really watch late night talk shows.
No. I mean, I just see the clips on YouTube. Comes across the feed.
Arun, does that sound kind of sus to you too?
No, dude, who watches TV anymore?
Who watches YouTube for clips of the president on late night
No,
television?
it comes across the feed.
That's what your feed entails?
My feed entails a lot of things.
Saeed's not on social media. He's on YouTube, so he gets a lot of the shorts on YouTube. He gets everything.
A lot of the abbreviated, smaller content.
Yeah.
For
the petite content, if you will.
I mean, if you will.
Yeah.
Yeah. It's very fitting.
You can digest it.
Very much so.
This truncated commentary. The below average attention span, if you will.
Wow. I mean, you're the villain, dude.
I feel like I'm just clarifying the point.
Yeah. All right.
Well,
also keep in mind, Argentina last year borrowed $44 billion from the International Monetary Fund, the IMF.
IMF.
$44 billion, and then they had a spike in inflation. They're like, yeah, we're probably going under.
Well, at least their debt isn't at an absolute historic high. Oh, wait a minute.
Wait a minute.
According to CNBC, consumer debt passes $17 trillion for the first time, not in Argentina, in the United States, everybody.
I mean, are these real numbers? Like, I feel like
17 trillion?
Every month, every quarter, we're just citing these new large numbers, new record, and you're just like, the fuck, man? Do these numbers even mean anything anymore?
Arun, you want to give us one of your
Yeah. I just picture him bam, 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 bam.
With the finger guns?
Yeah, I'm doing it for the YouTube.
Bro,
dude, come on, man.
Come on now. Total consumer debt hit a fresh new high in the first quarter of 2023, pushing past $17 trillion, even amid a sharp pullback in home borrowing. The total for borrowing across all categories hit $17.05 trillion, an increase of nearly $150 billion, or 0.9%, if you like smaller numbers, during the January to March period, the New York Federal Reserve reported on Monday. That took total indebtedness up about $2.9 trillion from the pre-COVID period ending in 2019. That increase came even though new mortgage originations, including refinancing, totaled just $323.5 billion, the lowest level since the second quarter of 2014.
Something that I thought was really telling about this was how, so they broke it down into all the different categories, and credit card debt actually stayed stagnant. And on its face, you're like, oh, okay, so wait, we've been hearing all these people not being able to afford things, and they're charging stuff on their credit cards just to get by. So, but credit card debt remains stagnant? No. So what typically happens is people rack up all their credit card debt by the end of the year.
Holidays,
and then usually beginning of the year, they start to pay that down. Maybe they get their bonuses. They start to pay down some of their debt. So for this is the first time in 20 years it's remained stagnant. It always drops down.
Great observation on your part.
Yeah.
But that was also in the article, so.
No, I did more digging than your CNBC article.
Did you? Wow,
That was actually
my CNBC
that was actually from The Hill, I think.
I would like to point out that was a solid catch by me.
Yeah.
You know, me catching you
You
cheating.
What?
You know you got that from the article, bro.
No, I didn't. I didn't get this from the article. From the Instagram post?
I didn't read it. I only read Instagram
now. So much more digestible.
Yeah. I can only take in so much.
Yeah, I mean, you could take it a lot. You could take it a lot.
I like leaving you in awkward silence. It's like leaving you on red. So as we hinted at the top of the show, Michael Burry loaded up on bank stocks during the banking crisis, I should say. Not to mention, this is a terrible photo of anybody, but I think maybe he just has to fart or something and pass gas. It's a very bad photo.
He doesn't care.
He looks very somber.
Yeah.
I'm just saying, if you're going to pose for a photo that's going to make the rounds on social media, talking about how you made or lost money, in this case, he did a little bit of losing money too. I would just say you'd want a little, smile maybe?
Just a little bit, right? I thought it was very interesting that he actually did this. And I wanted to actually get your opinion on it, but go ahead.
Oh, so he wasn't alone. Warren Buffett did the same thing. For some reason, this caught the attention of the media. There was only like 1 or 2 articles I saw today on Warren Buffett, but there's a lot of investors that have been kind of doubling down in the banking sector now.
Right. So let's give everybody a little quick refresher on who Michael Burry is. He was famously known for predicting the 2008 housing crash and actually made a lot of money on it. He was actually portrayed by who played him in the movie The Big Short?
Topher? No, it wasn't Topher Grace. It was
can't remember.
I don't know. But
one of the main characters in The Big Short, and he runs a very, very successful hedge fund, Scion Capital.
You could just read the actual quote from Wikipedia that Arun pulled up for you, so to make you look smart.
Wikipedia, you trust this source? This is one of your trusted sources now, I see, huh?
Yeah, I like Wikipedia.
Yeah.
I think just like famous economic scenarios, like Milton Friedman had alluded to, that left up to their own, most consumers will write a pretty accurate bio.
Christian Bale.
Christian Bale played him.
Yeah.
Ooh, yeah, I see that now. Yeah.
Oh, yeah. I mean, damn, he came up with Christian Bale.
Yeah, he does. Christian Bale can do a good RBF.
It could have, yeah. Homer Simpson.
Yeah, he has a resting bitch face. That's what it is. That's what it is. All right, so famed short seller Michael Burry took big stakes in regional banks during the first quarter. That's January, February, March for you kids out there.
Right.
During the first quarter, including the failed lender First Republic before it was bought by J.P. Morgan. Now, a little fun fact there, that investment gets wiped out entirely.
Exactly.
Yeah. He gets a big fat donut there.
Yeah, because depositors get made whole first.
His hedge fund, Scion Asset Management, snapped up 150,000 shares worth about $2 million at the end of the first quarter, according to regulatory filings. And I should point out that actually this week, and I think in some cases today, you had a lot of those mandatory regulatory filings of people who took positions in companies like this, and that's how this is making the rounds. It wasn't like he went out and told everybody. So today,
right?
I believe it is the 15th of Monday, the 15th of May.
Yes.
A lot of these filings came out, and you got to see this. So that's why the news is reporting on it. These people went out there going like, "Hey guys, look at the rest of this money."
Right.
So as these filings came out, big notable names like Michael Burry's firm, Scion came up. You saw Warren Buffett's firm come up, and people were like, "Oh my God, these people took positions in bank," which sounds counterintuitive. Why would you take a position in a bank amongst this contagion fear crisis when banks are trading lower and lower, and we know that short sellers in some part are driving some of these prices down?
Right.
Well, the answer is simple.
Okay, I want to hear it. I got a theory too.
Do you know?
Yeah, but I want to hear yours first.
It's not a theory, brother. I know the answer.
Okay, tell me the answer.
Don't give me this sarcastic, like your answer is whatever answer.
No, your answer is the answer.
Wow, you're gonna sass me on live live podcast now?
I'm on live. This ain't live. Why are you lying to the people?
It's a live podcast.
Yeah. Okay.
For us.
You're really showcasing why you're still the villain.
Is you upset about this?
Yeah.
All right. Well, let's finish this off, and then I'll give you my explanation here.
Okay.
So shares of the struggling regional bank had fallen more than 97%. This again, First Republic Bank this year before it was seized by J.P. Morgan. In a government brokered deal on May 1st. So seizure, wipe out stakeholders, assets that are remaining, sold to J.P. Morgan. So he gets nothing for that investment, nil. Why would he take the risk, right?
Right.
That's not the only regional bank he bought, though. And you head to the link in the bio here for the Bloomberg Business article, and it gives you all the information. Now,
Yeah.
this is what they did: is the investors
I
like
actually
them
have
said
that too, by the way.
the rest of the article.
PacWest, of his portfolio, PacWest makes up about 2.3%,
Mm-hmm.
and Western Alliance makes up 4.2%,
Two of the largest names are being dragged down in the media.
which we've been covering on the show.
Right. And his position is look, let's say the tangible book value for PacWest is $20 a share.
Okay.
I don't know what their actual tangible book value is right now, and who cares?
Okay.
Let's say they're trading at $5 right now. They're actually trading below that last I checked.
Yeah.
Or maybe.
PacWest?
Yeah, what are they trading at
I'll
today?
tell you right now.
So let's say they're trading at below $5 a share.
I have 535.
Okay, there you go. And let's say you buy them today.
Mm-hmm.
If they trade back up and they survive, the odds are they're going to get close to or at their tangible book value, at least 4 times
Right.
what you paid for them.
Right.
So let's say he buys $2 million of First Republic, $2 million of, a couple other banks, $2 million,
I think
spread
Wells
across
Fargo
all.
was in there. He also had a community bank in New York.
Yeah. So what he's trying to do is get 3-4x his money on at least 1 or 2 of those, and it pays for all of his losses and then gives him 3-4x gains.
Absolutely, yeah.
But this goes to show you that the fear now is not necessarily the same as when it was a couple months ago when everyone's like, oh my God, all these banks are going to fail.
Mm-hmm.
Now some of the most brilliant financial minds in investing
Right.
are now betting on these companies being around and recovering.
Yeah, and I think it all can be contributed to the fact this is why it's really important to stay in tune with all the reports that come out and being able to read the tea leaves on what the Fed's going to do next and listening to the higher standard and all of that. So if
Mostly listening to the higher standard.
mostly, obviously.
Yeah.
If he truly believes that the Fed is going to halt, the rate hikes and do a full pause, then perhaps he thinks after that maybe some of the bank stocks will start to recover. Because now, maybe because we've said it before on the show.
The optimism, the perceived optimism, the behavioral economics, the human portion of it.
Yeah.
Will start to kick in and go, okay, I feel comfortable that the bad times are over for the banks. I'm going to invest in them. But these guys wanted to get in before the general public did.
And not just that, though. We've said before, the pain for the banks is in the rise of the rates. Once they stop, it's on the consumer at that point. So whatever banks are still around, we've said on the show, they'll be fine. They'll be in good shape, and perhaps they'll start to recover. I don't know how long. I don't know if they get back to their true tangible book value, but that was the theory that I had on it. And the reason why this is coming out, like you said, he's not coming out and saying this is what I'm investing in, guys. Right? He's also very much aware that he's required to report what he invests in. I think what I looked up is that hedge funds are typically required to register with the SEC if they maintain investor assets of more than $100 million. Okay?
Yeah.
So, but I wanted to do a little bit deeper dive on hedge funds and what are your thoughts on them? Are they risky? Just your general thoughts on hedge funds.
I've been noticing a trend of you wanting to go deep all night tonight. Oh, man. And I respect your willingness to take on more information.
I just know what I'm capable of,
Yeah, and you know what? And not all people are willing to stretch themselves that thin.
He's been slowly getting deeper.
He has been, right? I mean,
Yeah.
when he started, he wasn't capable of doing that, but he had to really loosen. I can't do it.
You tried.
I tried. It's just too easy. Hedge funds do carry a certain degree of risk, hence the reason why Silicon Valley Bank went down, right? They take speculative positions that are generally inherently more risky than other people would, but they basically take larger bets on risk to take bigger returns.
Right. They have a concentrated investment strategy.
Yeah. Venture capital, private equity, a lot of them play the same type of investment games. Hedge funds, however, have a little bit more of a stigma and a uniqueness to them. They operate so many different ways. Some of them are algorithmic trading. Some of them are effectively micro investing, but they're taking a bunch of money in, and they're all trading in a proprietary way, usually proprietary way.
Right.
But yeah, they can make some pretty significant swings in returns. Now there are hedge funds that really suck.
Right.
Kathy Woods, right? She has a hedge fund, doesn't she? Ark Investments.
Yeah.
Yeah. She.
Damn.
What?
Kathy Wood catching strays.
Hey, man.
bro, you've taken shots at her every chance
You
you've
know what?
gotten.
Okay, look. Okay, I understand what this is going to sound like. It's going to sound like hate. This is not hate. Okay, this is what this is. This is truth, the
Okay.
painful truth.
Right.
All right. This woman has been all over CNBC. I don't know.
I don't like the way you're
Who-
flexing your Travis Scotts at me. By
I'm
the way.
flexing the shit out of my
you
Travis
pointed
Scotts
that shit
on
right
you.
at
Yeah.
me. I'm putting my chucks over here on the other
Yeah.
side. Get them shits away from me.
I'm sorry, my shit. Get them shits. Yeah, I licked the bottom of these for the show.
I'm not gonna lie, they're sexy.
Yes, actually, all the other ones I like better.
Okay.
So I bought these. They got to the house, and the same weekend they literally were delivered my door the same weekend on Saturday.
Yeah.
Right outside my door. I'm waiting to go home and pick them up, and we're at the Irvine Spectrum. We're just going into a movie. My wife goes, "Huh, I like the yellow ones better," because they had the yellow ones there.
Yeah.
And I'm like, "What the fuck? I asked you yellow or brown. You said brown." She's like, "Yeah, I was wrong."
This is how arrogant you are now.
What?
You fucking randomly coming into the studio with Travis Scott's, just walking around like it's no big deal, acting like this is just what
Well,
I
you're
do.
the one with the 100 grand from the Federal Reserve and bread behind you.
This is one of the coolest props of all time.
The artist is Daniel Allen Cohen. He's a stud.
He's been on the show.
Been on the show.
BS before Saied.
Yeah, BS before Saied.
Yeah.
Brilliant artist. This is one of the many pieces, a sculpture, if you will,
Right.
that he's put together. We actually have some pieces that we're putting up in the studio that are very high end.
Right. Not
pieces from
real.
him.
Don't come rob us. Yeah. This is not real money in here.
Well, it depends. If we're influencers, then that's real. If we're not influencers,
Right.
then it's not real at all.
Right.
But that being said, Ark and Kathy Wood are all over CNBC, and they constantly ping her for her input. And I'm sitting here going like, dude, she's been down so goddamn much the last 2 years.
Right.
At what point do you start saying, you know what, maybe we should get somebody else's opinion? Maybe we should get someone who's got a W lately.
Yeah.
You know what I mean? But I don't understand.
You know what it was? It goes back to what you were saying in general about everyone that was investing the last decade.
Yeah,
last 14
congratulations,
years.
you crushed it.
We all won.
Yeah, now it's hard, and guess what?
Yeah.
Some of y'all taking L's.
Some
Yeah, well, not everybody.
handing out L's, but
Although Tudor has an opinion we'll hear about later on directly from him about where this goes.
this guy is such a baller, by the way. I looked up some of his interviews, listened to him. I was like, I love it.
Yeah, very low key baller, not
Yeah.
high key.
Yeah.
Low key baller.
Low key baller.
Yeah.
But the other thing to point out with hedge funds, they tend to cater to high net worth individuals, right? So there's that stigma.
Well,
of
they
it as
need
well.
people who are willing to take big bets on risks.
Yeah, and they tend to require you to hold your money in there for longer.
So you word stuff like that on purpose, and you get yourself in trouble. They require a long-term financial commitment, you dirty birdie.
They like to hold.
Hold it in there for longer.
Dock it.
Yeah, there it is. I knew it was coming up at least once an episode, every episode, like clockwork. There's a docking reference.
Got to.
And someday we're gonna have some poor soul
Shame
who's
on
gonna
everybody.
look that up.
Shame on everybody for not replying to my stories and saying I got the reference. Everybody.
I don't think there's anybody who actually follows you.
Oh yeah,
That's-
it's a ghost account.
It's a ghost account. All right. So before we play this clip, there was an article from CNBC which I found in this clip, which references the billionaire hedge fund manager Paul Tudor.
Mm-hmm.
I wasn't going to listen to the whole thing, but I got to tell you, it was kind of an intriguing listen.
I listened to the whole thing.
Yeah, it went on for a little bit longer than I wanted to. We're going to play it for you all, so you guys get to hear it.
Mm-hmm.
But billionaire hedge fund manager Paul Tudor Jones believes the Federal Reserve has finished raising interest rates in its fight against inflation,
Yeah.
and the stock market could grind higher this year.
Yep.
That's right. He thinks it's going to go higher. The central bank has raised interest rates 10 times since March 2022, taking the Fed funds rate to a target range of 5 to 5.25%,
Mm-hmm.
the highest since August of 2007, also around the time of a little thing we like to know as the Great Recession.
Yes.
So the consumer price index has cooled considerably since peaking out at around 9% in June of 2022.
That's the only messaging I didn't like.
The gauge eased to 4.9% in April. Why not?
I mean, cooled considerably. Okay, so overall it's down to 5%, but core's up. I mean, when core inflation is higher, what are we doing?
Again, I mean, so here's the problem. There's a really challenging conversation I need to have with you, okay?
Yeah.
I mean, Paul Tudor Jones,
Manages $13 billion in assets.
and he himself is a billionaire.
I mean, what? Just because I'm not a billionaire, I don't.
You're a
have,
laureate,
Yeah.
okay?
Yeah.
You have a different perspective.
Yes.
yours affords you poverty, while his affords him riches beyond belief.
Right. So
I'm not saying that you're not right.
Yeah.
I'm just saying if I had to be someone's friend, it'd be him.
Come on, man. You choose Paul over me? This guy.
Bro.
This guy looks like he doesn't know how to have a good time.
He looks like he had a great time and just threw his tie on for a photo.
Yeah.
8 years later, he founded Robin Hood Foundation, which focuses on poverty reduction. So look, he's looking out for you. Poverty reduction.
Not to be confused with Robin Hood, the investing platform.
Yeah, no, it's a foundation. As of April 2022, his net worth was estimated at $7.3 billion. Just $7.3 billion higher than you. Or me.
Yeah.
Or me.
Yeah. So he says that if we do, in fact, get a pause in June, he says the playbook is very easy on how this plays out and what you can expect to see.
He was very laissez-faire in the interview. He was like, meh, this is what happens.
I mean, I feel like if I was worth $7 billion, I would be too.
The level that he did not give a fuck in the interview was
Like,
palpable.
This shit doesn't affect me like it affects you guys.
He's like, yeah, I don't really think it's a big deal.
You guys care about this?
I mean, inflation might be like 9% of what?
Yeah, exactly.
You know?
Like, come on, we know it's more than 9%.
Yeah.
Come on.
He doesn't care.
Brune, but he
play
said,
that funky music, white boy.
Oh, yeah.
Or not. That's fine, too.
I actually want you to react a little bit to this Austin Goolsbee interview and some of his comments. I'm curious where you think interest rates will go, should be. What do you think?
I think they've done hiking. I'm so glad I don't have his job because listening to these guys try to not say what they really want to say and what they really think.
What do you think he really wants to say?
Oh, he wants to say we're done, we've gone too far, and enough's enough. That's what he wants to say. He just can't say that because he's new on the board and he has to follow the chairman. But that's what he wants to say.
And what do you want to say? If you're on
I
that
think
board?
he's right. I think they're done.
You think they are done?
Oh, definitely, I think they're done. I mean, they could probably declare victory now because if you look at CPI, it's been declining 12 straight months. 12 straight months. That's never happened before in history. So there's a strong downward arc to inflation at the moment. 2-year break-evens are under 2%. Clearly, they have to be governed by trailing 12-month inflation. But if we get to the here and now, you can see that inflation, to a great extent, has been wrung out of the market. Now, does that mean that we're getting ready to imminently cut? No. But you got to think of interest rates a bit like chemo. So chemotherapy, chemo is poison. Interest rates with the kind of amount of sector-wide debt that we have between private consumer and the government, we're probably at levels where we've typically hit a recession in the past because of the interest tax on the economy. So we're at a level that historically has really slowed the economy and historically has kicked off a recession. I think it's just a question of waiting for that tax on the economy to work its way through.
Mistake then for them to raise interest rates?
Would have been a jump ball for me. I would have been 50-50 on the last one. I could have been talked out of it. I would have been reluctant to do it. The only reason why I probably would maybe have gone along with it is because I think equity prices are going to I think they're going to continue to go up this year, and the financial cycle drives so much of the business cycle.
Okay.
So,
but let me just pick up on what you just said. You said you think equity prices are going to go up this year.
Oh, yeah.
So you think they're going to end higher than where we are right now?
Oh, yeah.
Okay, real economy is going to be...
Could go into recession in the third or fourth quarter. And when I say we're going to be higher, I'm not rampantly bullish because I think it'll be a slow grind.
So in this interview, there's actually more to this interview that I watched. And what he goes on to say is that the playbook for this is if the Fed does, in fact, pause, this is the playbook. 6 months from now, stocks will be up 10%. And 6 months from now, you can expect the Fed funds rate to be cut 50 to 75 basis points.
I would not be upset with that outcome.
I wouldn't be upset with it either, but we talked about it a few episodes ago that, you know, when the Fed decides to hold rates, they hold for much longer than 6 months.
Yeah, but I think there's a tremendous amount of pressure with the election in November 24. I think that
But they
the
shouldn't
Fed.
they should be acting independently.
If you want my honest opinion, I think Jerome Powell knew that he'd gone too far in the last interest rate increase.
Really?
Yeah.
You think so? With the what's been going on in the banking crisis?
I don't know that the banking crisis in and of itself was enough to convince Jerome Powell that he'd gone too far. But I think the fact of the matter is that they're trying to stick to monetary policy, which has worked historically, and I think there was a palpable amount of concern that the numbers were going the right way. They felt really confident in what was happening, but they didn't have enough data input to stop. And they've told everybody they're going to be data-driven. And because they didn't have the data to point to say, hey, we're good, this is why, they kept going because that's the pitch they've made.
Okay.
But I think deep down inside, he knew. I think the FOMC knew.
Okay.
But I think they just don't have a data to point to, and they've said this entire time, we're going to be data-driven here.
Yeah.
So maybe that's as simple as that, but that was just my kind of feeling.
They said, but Jerome Powell said in the minutes of the FOMC meetings, they've mentioned how they need to see it going down on a fast enough trend, and we know that they know that around this mark that it's at now is when it gets sticky. So maybe they wanted to see it get past this hurdle before pausing.
Well, I mean, what does that look like? That it goes from...
I don't know what that looks like, yeah, but we mentioned that it would need to be somewhere around that 4% mark.
Okay, but...
Right? And if their preferred measure is core inflation, they're not getting there. Come on, we know they're not getting there.
No,
and that's why
they're
from
not.
the beginning we said...
Unless home values come down.
Unless home values come down, because that's a huge component of the entire report. And I mean, I don't know if we both agreed to it, but I said it from the beginning that they're going to walk away from this 2% target mark, whether they mention it or don't mention it, because I don't think it's possible.
I think the biggest hurdle for them getting there now is they wildly underestimated how overvalued the real estate market is.
Yes.
And the contributions in rent and rent equivalent being north of 34% on inflation is going to be such an anchor for them that they will not be able to overcome that to get to their target inflation. And they're going to have two choices. And I'd be interested to hear your take on this.
Okay.
Choice number one is they do exactly like you suggest. They abandon the 2 to 3% target rate because they just feel like they can't get there in a reasonable amount of certainty.
It's to the point where he can never admit doing that, though. They're going to walk away saying, okay, inflation's on a downward trend. We see where it's going. It's good enough. We the FOMC believe that it will hit its 2% target mark if we just pause here and walk away.
Okay, so then option number two. And I want you to know that Mr. Powell has come out and outwardly said he is a huge fan of Paul Volcker.
Yeah.
Paul Volcker is notoriously famous, like we started off the top of the show, for causing that double dip recession.
Yeah.
Do you think he goes back to the well and tries to increase rates again because he's trying to get home values? Without saying home values, he's trying to get home values to come down.
I don't think so, because I think he can still pause and still, pay some respect to his boy Volcker.
So
because
you think
we know that pain comes for the consumer during the holding process. So if that's the case, then if he holds now, we will still likely hit another recession, because we believe that Q1, Q2 of 2022 was the first recession.
I think we'll look back on this and think this is one of the longest recessions we've ever been in.
Yeah. And
Yeah,
I mean, there's
2
some
years, probably.
Yeah, there's actually some reports that are coming out this week that are really important, that should be very telling. I know tomorrow the U.S. Retail sales report comes out. That's going to be huge, because that gives you a really good insight into what's going on.
I'm not expecting anything sexy from that report.
No, I mean, well, so what we saw there the last several times. So in November, December, we saw negative readings, and then in January we saw this wild jump for no reason when that should have been December's reading. So no one really understood why that was the case. But then in February, March, we saw negative readings again.
I expected a similar negative reading this time.
Okay, well, that's interesting that you say that, because I think the projections are a positive reading of 0.8%.
Yeah, I think you get like a negative like 5.
I think you see the consumer pulling back again.
0.5%, I should say.
I think you see the consumer continuing to pull back, and that'll be another big report that comes out.
I guess what is the consumer spending on right now? Like what are they? Vacations maybe? travel and
I mean,
services.
we're seeing on all those jobs reports that leisure and hospitality every month they're one of the
man.
leaders in adding jobs.
I know. I travel. I mean, you were on a plane recently with me on the way back from San Jose. How packed was that plane?
The airport, everywhere. Yeah,
Packed.
it was packed.
Yeah.
And we actually had some of our listeners reach out to me and they said, "Look, I know what you guys are saying about construction, but like I literally have 3 to 4 months worth of work, ready to go."
Oh yeah, backlog. Yeah,
And definitely in the single family space.
Mm-hmm.
So
I believe it. Again, we never said that it stopped.
I don't think it's stopped, but it's interesting because we know that sector is so sensitive to interest rates.
Well, historically, but keep in mind, builders, when they got hit with the Great Recession,
Mm-hmm.
they started building up a war chest of cash,
Right.
and then the COVID recession hit.
Mm-hmm.
Then they started. There's this pent up demand, and they all went out 18 to 24 months. So a lot of those projects are coming online now. So even though they have a backlog of 3 to 4 months,
Yeah.
that doesn't give me a great deal of confidence because, again, like we said before, what we're seeing right now is a liquidity pullback from banks, although it's being labeled wrongly as a credit crunch.
Right.
What comes next is a credit crunch, but I can tell you that most banks are not willing to deploy capital into speculative construction deals right now.
No.
If they're going to go in, they're going to go in with a really strong credit profile. And while a lot of the builders are going to meet that criteria,
Right.
you're not going to see anywhere near the money going out for riskier type investments in construction, whether they like it or not, is a riskier type of asset class as far as investments go.
Yep.
So I think you're going to see a pullback there regardless.
Mhm.
Again, I just don't think we're there yet. So this whole we're in a credit crunch. We're not in a credit crunch. We're in a liquidity pullback. And what comes next will be a credit crunch. And that's when you start seeing the impact. But you don't start seeing that as a consumer in the market, in the landscape,
Right.
for about 12 to 18 months afterward. Because keep in mind, there's still a steady pipeline of construction projects coming online,
Right.
being pushed to completion, finished, and brought to market.
Right.
So then what happens? They come to market. They'll start to go down. The construction project pipeline starts to dry up a little bit.
Okay.
And then the consumer and the news cycle and everybody picks up on it.
Okay. So then why do you think confidence in Jerome Powell is plunging right now to a record low?
Well, I believe the technical term is Jerome Powell has been kind of an asshole.
But if he's saying that his favorite mentor is Paul Volcker, who caused 2 recessions, right? And if he's able to cause a recession that we all anticipate that's going to happen, but unemployment somehow remains low,
Mm-hmm.
and we come out of this on the other side, yes, obviously it's
Unemployment will not remain low. Do not buy into that shtick.
no, but low. What's low? We consider healthy under 5%.
Yep. It will not. I think unemployment will probably be closer to 7%.
Yeah, because it peaks after the recession is declared over.
Yep. Correct.
Right. Yeah.
So let me be honest. Okay. Jerome Powell is not a bad human being. He's a very, very smart guy. But I think that the Fed has made some very visible mistakes, and instead of owning them,
Yeah.
and humanizing himself a little bit, he has taken a much more, I think, political or democratic, not in the Republican Democrat sense, but in more of a, he's just trying to present himself in a way where he almost sidesteps the Fed's omissions here.
I think he's very careful and calculated in what he's saying because he knows everyone is hanging
Which
on
is fine.
every last word
But
that he
that
says.
doesn't mean you shouldn't take ownership of the fact that we got here
Mm-hmm.
by the Fed acting too late.
100%. There's no reason why I personally didn't think that, Silicon Valley Bank, First Republic Bank, I mean, they were well-run organizations.
Mhm.
They didn't deserve, any of this.
But there are very different reasons why they failed. Silicon
Absolutely.
Valley Bank had a lot of speculative investments,
Mhm.
a lot of exposure to tech.
A lot of
They had
concentration.
concentration, which wasn't good. Okay.
Mm-hmm.
I look at First Republic Bank and I think to myself, that's not what happened there.
Mm-hmm.
They chose a low margin business. They chose to make loans at lower dollar amounts for high net worth individuals and give out higher interest rates on deposits for high net worth individuals because they had a lot of deposits they would bring there,
Absolutely.
right? They chose to make less money and invest in credit they didn't think was anywhere near as risky.
Right.
So they chose to have strong credit and low returns and trusted that the Fed would never stress them beyond their own stress predictions.
Right. And you can't blame a guy like Michael Burry, willing to pick up some stock
No.
of theirs because
Because
all
look at their
signs,
profile. Yeah.
and all signs pointed to, listen, everyone and their mom is not going to let this bank fail. Look what everyone did to make sure that, or at least attempt to make sure that they weren't going to fail.
So
right?
again, we talked about it in the previous show, right? You look at the fundamentals. You look at their income statement.
Yeah,
You look at their balance sheet. And don't people forget, First Republic beat their earnings expectation.
that's the crazy part.
They beat their earnings expectation and still traded like 60% lower that day because of the deposit outflow. And then this whole fear kicked in. And granted, there's a lot of things happening behind the scenes that we'll never gonna probably have full vision into. But they beat. So the income statement was strong. The balance sheet was probably getting weaker. But they didn't trade down based on their fundamentals. They traded down based on the perception that they were going to fail, not in the fact that there was things that they were doing wrong that would lead them to failure.
Right.
And then as more and more of that started to spin around, more people pulled their money out, causing more and more stress on the organization, which ultimately led to about $100 billion in loans, in this case, deposits made to them. So, look, but here's my problem with Jerome Powell. I respect immensely the job he has sucks and that it's difficult.
Yeah.
And that even if he handled it with grace and dignity and all these amazing things, people are going to criticize him anyway. But I don't understand why, if you're so focused on being communicative, more communicative than any Fed had in history prior to this, right?
Right.
Why wouldn't you come out and say, hey, you know, we acted a little bit too late because we were concerned we were going through an unprecedented pandemic. We didn't want to pull the trigger too soon and damage the consumer, so we waited and were a little bit more vigilant as what was happening because it was unprecedented before. And we knew the stress that was on small businesses. We knew the stress that was on the consumer. We knew the stress that was on the economy.
Right.
So we waited. And in retrospect, that probably wasn't a good idea. But we decided that in an unprecedented time, we didn't know what was going to happen. We didn't have a history book to look at for this. We wanted to wait and see. And maybe we waited too long. We probably waited too long. That's why we feel the need to do this in an expedited fashion in a year, and at least be open with the public on that.
Absolutely.
And the fact that this is like this big, great giant white elephant in the room that no one's ever talking about, and is the same question I've asked over and over again on the show. Why are we doing this in a single year? Why did we have to do it at this cadence?
It's not just him though, right? It's and I think Paul Tudor, is that how you say his name?
Paul Tudor Jones.
Paul Tudor Jones. What he went on to say later in that interview was like, there's bad monetary policy that happened, which is monetary policy controlled by the Fed, but also bad fiscal policy. What did the government do leading up? So it's a combination of both that's not getting enough attention right now.
And that's why it's totally unfair for Jerome Powell to have the approval rating that he has.
Exactly.
It's totally unfair because he has been undermined every fucking step of the way.
Yep.
By fiscal policy.
Yep.
By the government spending and the government's behavior.
Yep.
I mean, look at the rhetoric in the news right now. It's all about, oh my God, is the debt ceiling what's going to happen to the debt ceiling? Oh my God, debt payments, oh my God, what are you going to do? Oh my God. And it's like, why are we freaking out?
Yeah.
Like the 78 of the last 78 times, man.
Yeah.
Over hundreds of years.
They raised it. Yep.
So this from Bloomberg Business. Public confidence in Jerome Powell's leadership of the Federal Reserve has dropped precipitously, according to a new survey, and is now at or below his predecessors as the central bank wages its war against inflation. A Gallup poll released Tuesday shows 36% of U.S. adults say they have a great deal or a fair amount of confidence that the Federal Reserve Chairman would do or recommend the right thing for the economy. That's lower than Janet Yellen's 37% during her first year leading the Fed in 2014, though the difference is within the survey's margin of error for plus or minus 4 percentage points.
Right.
And is the lowest record since Gallup began tracking public confidence in the central banking chief since 2001. Former Chairman Ben Bernanke's lowest point came in 2012 at 39%. Just as a little reference point there. So
I do think he's
pretty low.
He's going to do what's right for the economy, and this is part of his job, okay? He's going to decide to hold rates or cut rates when we're on the brink of a recession, or if there is a significant crisis in one of the financial markets. And he can go on and say whatever the hell he wants about the banking sector being sound and resilient. It ain't. Okay, and he knows it's not, because I think the deposit insurance fund only has, initially, I think of December last year, had $120 billion. They've already spent $30 or $40 billion.
Arun, hold right there. I want to read some of those comments.
Right? They've already spent $30 or $40 billion. How many more banks could he allow to fail? That's a significant crisis, dude. So there's 3 steps to a Fed pivot, right? You have stage 1 is during, the raise of the rates. Stage 2 is when they hold, and stage 3 of the pivot is when they finally start to cut. So if June hits, we're finally in stage 2. So if you want to look at something on the bright side, okay, we've now cleared stage 1, we've now hit stage 2, and it's only a matter of time until we hit stage 3.
Look at you providing little rainbows and unicorns.
Trying,
and
man. We out here.
Lollipops and gumdrops.
Come on now. What were some of these
God damn.
comments?
So these comments are actually not what you think.
Okay.
All right, so because the average person knows so much about the economy, he is doing an excellent job. He is not responsible for how the banks are operating. They had as much notice as the rest of us to pivot and move. So let's pause right there. I see stuff like that, and I think to myself, okay, so not only do you – look, I don't mind you defending Powell. Fine. But you clearly know jack shit about the banks.
I'll say,
okay?
well, can you get there quicker? Not only are you stupid, but yeah.
So tell me you're a fucking moron without telling me you're a fucking moron. But
132 likes. All you guys are morons too.
Yeah. Well, first of all, so the banks had as much time as notice as the rest of us to pivot and move. Yeah. I don't know if you know this. Wealth Financial Flowers.
You're about to catch some strays.
Okay. I don't know if you know this. Wealth Financial Flowers LLC, your company. But let me explain something to you, okay? You pivoting your $100,000 company and me pivoting a multi-billion-dollar balance sheet,
right? Which,
by the way, has a lot more rate sensitivity than you do,
right?
Okay. In a single year, my borrowing costs go up every single time the Fed interest rate increases their rate directly.
Not to mention,
you are indirectly impacted by this, and you want us to react to an unprecedented thing. And by the way, they had as much notice as the rest of us. No, asshole. Your notice is what's happening to the banks, and your impact is what comes next.
Right, exactly. Not to mention these assholes that are given the credibility to write these articles online and just trash a bank that have no knowledge base.
No knowledge base
of what's going on.
But it's sexy.
Yeah, exactly.
It's news.
And they got the click though. They got the click. That's all they want. That's all they care for.
I want you to click me hard.
Click it.
That's what it happens. So let's read some more. Most people have no idea who he is. If asked people I know about Jerome Powell, they would be like, that brother from the hood. That's a comment.
Is that wrong? Hey, is that wrong? That's not wrong.
Jerome Powell, that brother from the hood, right? Yeah, I know him.
Oh, JP?
Yeah.
Oh, you heard what happened to JP?
Yeah, I heard he blew something up and then like rates just rate of something with a crime maybe. I don't know. Right, go back up. The next comment. Jerome Powell has done an excellent job. Fair comment. Who could do it better though? Great comment. That's a valid question.
Facts.
Yeah. R.I.P. Me wow. I don't know. Whatever. Let's go to the next one. You're in the subtopic. There you go. I would reckon the average U.S. adult is ignorant of the complexity of macroeconomics in the U.S. financial sector. Seems a little negative. Let's see where he goes with this. Powell has done a resounding job since taking the role. Pre-COVID, Powell sought to undo the damage of ZIRP and QE.
Quantitative easing.
Of the Bernanke era. Okay, facts. True. The Fed, under its pressure, did its part to keep the economy afloat during the pandemic. I would say possibly, depending on your interpretation. Not a bad comment. And now the Fed is pulling its levers to cool inflation and an overheated economy. Don't blindly criticize what you do not understand. Yeah, that's fair comments.
Fair comment. I mean, what are they saying? What did they do during the pandemic? The fact that that would be insinuating that he knew that he had to raise rates, but he didn't.
Yeah. Look,
because he thought inflation was.
He's not a dumb man.
No.
Oh wait, here's another one. Let's go to Zubvik or the next one there. The only people who voted was Wall Street. Obviously, they don't like him. Their cost to do business is high. Oh, the only people who voted that they didn't like him is Wall Street.
Oh.
If Middle America understood we need to keep interest rates high to lower inflation, they will agree. At least the educated ones, the lesser of two evils. Okay, but I would also argue, did you need to do it this high? Arun highlighted a quote here. Because most people don't know the first thing about economics, Powell is answering to Congress's spending sprees and stimulus checks. Powell is easily the most impressive chair in the past 2 decades. Look, every comment we've read so far, and again, like Milton Friedman's classic financial modeling, right? If left to their own, generally small business and consumers will do the right thing. Here in a public forum, right, on Instagram, where I get all of my really relevant news.
Digestible news.
Click me, baby. Yeah. Look, guy is taking down more regional banks than Ben Affleck in The Town. There's always one of those.
Yeah.
But look, the overall rhetoric is resoundingly positive in favor of him, despite this. There was a Gallup poll, and he's negative. Right. I think anybody who sees the stress in the economy, who's going to get votes, whether they like him or not, would generally get negative votes because people feel like negativity needs to be placed on somebody.
Right.
So, but that isn't the reason why that I hate Kashkari. Kashkari is a piece of shit. That's just a different conversation.
But if you think his approval rating is low now, I mean, wait till you see the months to come when he decides to hold the rates for the rest of the year.
Hey, you never know. It might go up, man. It seems like the general public thinks by Q4 2023 he'll be a hero. There you go. See?
By Q4
2023, yeah. It's 6 months. Yeah, maybe
that's a little optimistic.
Maybe Q4 2025.
There you go.
None of the former chairmen served after a world pandemic.
I'm pretty sure Volcker wasn't celebrated during those 2 years.
I celebrate the shit out of Volcker.
No, now.
Yeah, I love his rules.
Yeah.
I just don't like his price tag on his book.
Yeah.
Okay, so according to Reuters, U.S. bank deposits rise in early May, lending little unchanged at record high.
Good. That's a good sign.
Is it though?
Is it not though?
I don't know. Innuendo, not my endo.
UOENO.
Deposits climbed to $17.16 trillion in the week ending May 3rd, up about $67 billion to mark the first increase in 4 weeks. The Fed's weekly snapshot of the banking system's assets and liabilities showed deposits, which had dropped substantially after the collapse in March of Silicon Valley Bank, rose at both large and small banks.
Thank God.
That's a positive sign, brother.
Yeah.
Total bank credit was little changed at $17.37 trillion, while loans and leases for U.S. households and businesses held at a record high of $12.12 trillion, that is, although annual loan growth is now the slowest in about a year. So not only is the loan growth the slowest in about a year, but balances have stayed about the same, which speaks to our theory. This is not a credit crunch. This is just banks are afraid to deploy capital.
Yeah, right now. Because, well, not just afraid. It doesn't make sense for them to. Also,
doesn't make dollars. Doesn't make sense. Little cliche.
I was gonna be the nice guy and be like, "Yeah, you're right." Yeah,
little cliche. You're not gonna let me have that one. But don't make dollars. Don't make sense. Put that in the headline. That's the show name. Let's go. We had way too much caffeine tonight.
Some asshole has a TikTok who said that, and they're like, "Yeah, that was the best shit I made all year." You see what I did? Bars.
You gotta explain bars to people who are not alcoholics.
Come on, man. If you don't know, Urban Dictionary. We covered Urban Dictionary last time. Go ahead and look it up.
We probably send a shit ton of people to Urban Dictionary on a daily basis.
I know, seriously.
What the fuck is docking? Let's see, docking, bars, high key, low key.
We're not gonna.
Can you low key dock?
We're not gonna get. Oh shit! Oh my God!
Saied dropped his phone and pushed the mic out the way. High key
bars. Yeah, here we go. What is this?
Sentences in lyrical hip hop songs. Sentences that rhyme with each other. 300 bars is 300 sentences that rhyme.
Yeah, but that's not how the kids use it. So usually when someone says something that sounds catchy or makes a lot of sense or has a hidden meaning and you have to decode it, you're like, ooh, bars.
So you're telling me that your cunning linguistic skills are so up to date with what the youth feel like in America that you know more than Urban Dictionary knows about Urban Dictionary?
Go up right here. Yeah, perfect. Thank you, Odin. To have skills at originates from bars representing levels in video games. No, that ain't right.
See, you don't even know your own definition now.
To be good at something.
You're out of touch, bro.
Yeah, to be good at something. That's good.
You can't
keep it
say
simple. To be good at something.
Saied is bars.
Said's got bars.
So you got good at something?
Yeah. I think so.
Could you use it in a sentence, please?
This is the first time Urban Dictionary has failed us.
It really did fail us. Bit.
The examples were a little weak.
Yeah, Urban Dictionary is written by you. Not by me, kids. Not by me.
Right.
All right, let's go on to the next article because at this point in time, we're getting off topic again. You want to go, we're crossing the hour mark right now. You want to go rapid fire sesh?
Yeah, let's do it.
Bang, bang, all the way
Bang-
through?
Yeah, Uchi Wally Wally.
Whew. All right, pace yourself. Take a deep breath.
You got this?
Yeah.
Chief, that's a lot of reading for you.
That's a lot of reading, but this one's important. So we're going to hit you the highlights. You're not going to get a lot of digesting with this one. We're just going to go right into it, okay?
Yeah.
So look me in the eye sockets while I'm saying this to you on YouTube. For those of you driving, hum along with me, kids. Yeah. Investors lost money on roughly 1 in every 7, 13.5% approximately, homes they sold in March, according to a new report by Redfin. In comparison, only 4.8% of overall U.S. homes that sold in March sold at a loss. This from an article from MoneyWise titled, U.S. Real Estate Investors Are Losing Money on Roughly 1 in 7 Homes They Sell, among the worst since 2016, and they're most likely to take a hit in these 5 cities. Yeah, that whole thing was the title. Crazy.
Mm-hmm.
That followed a dire month in February when real estate investors lost money on 14.5% of homes sold, the highest rate since 2016, and a long stretch from the record monthly low of 2.8% in May of 2022.
Right.
In March, the hardest hit market was Phoenix, Arizona, where 30.7% of homes sold by investors lost money.
Mm-hmm.
Phoenix was followed by Las Vegas, Nevada at 28%, Jacksonville, Florida at 20.9%, Sacramento, California at 20.2%, and Charlotte, North Carolina at 17.4%.
That sounds pretty spread out.
All 5 of these were massive pandemic boom cities.
Right. And you can what do you think is the number one reason why, they're experiencing some losses? Do you think it's the carrying costs on the loans? And they're forced to sell?
I think a lot of them were so the huge trend, if you will, on social media and really it's actually permeating traditional media, which is really pissing me off, is the whole you can buy with no money down, blah blah blah. So people are teaching other people who are not sophisticated investors to buy using hard money loans that are really expensive, above market rates.
So what is a hard money loan?
So if you go to a traditional bank or lender, a normal loan would be you go get a loan and they give you a normal, call it relative market rate. And I'm watering this down a little bit.
Right now you're looking at what, 6.3%, 6.4%?
Yeah, that would probably be a normal rate. A hard money loan is a lender of last resort, if you will, or somebody who's willing to take on additional risk than a more conservative bank would take on, and they'll give you a loan. Sometimes they'll give you a loan up to 100% of the home's value, but the trade-off for that is they get paid quite a bit more. So,
and some people view it as predatory lending too.
It can be very extremely predatory. So a lot of times these people, so when you go to these social media courses and they give you their secrets.
Yeah.
The secret.
Yeah.
The secrets are often you need an LLC. So go form a limited liability company because these hard money lenders are not going to make a loan to a consumer because they don't want it to be predatory.
We just saved you money from having to go to a seminar.
Yeah, you don't have to go to a seminar. Congratulations.
Yeah, you're welcome.
Hashtag blessed.
Now go leave us an honest 5-star review.
Bars.
Yeah.
I was waiting to get that in the whole time.
You're like, well, what am I going to say, a bar?
All right, so rapid fire session continues. A problem for the housing market. People won't quit their cheap mortgages. Fewer homes are available because homeowners are hanging on to coveted rates of 3 or 4%. This from the Washington Post. A quote from the article, at the end of 2022, 62% of mortgage holders had a rate below 4%, and 82% had a rate below 5%, according to Redfin. Once again, Redfin dropping knowledge out here in these streets. Data.
Right.
A whopping 92% had a rate below 6%. And Arun, if you could bless us with the chart, brother. It looks like a pretty ocean, doesn't it? It's very oceanic.
Feels like something from Minecraft.
It does have a little Minecraft-y, little notchy vibe there. But the point is you go back to 2014, rates were generally a whole hell of a lot higher on average. And then in 2020, boom, below 3% became a thing.
Right.
3 to 4% became a much bigger thing. And 4 to 5% and 5 to 6% came way, way down. But the other thing you need to notice here is overall borrowing in aggregate is still much higher than it was in 2014.
Oh, yeah, absolutely. I mean, back to our consumer debt now exceeding $17 trillion. There's another sign is that balances on home equity lines of credit increased $3 billion at the start of the year, rising for the 4th straight quarter after declining for nearly 13 years. That's a problem, kids.
That's a little problem.
So, people aren't. So, credit card debt remains stagnant. Okay. We already broke down why that shouldn't have been the case. But, okay, let's say you look at that as a positive thing. Home equity lines of credits are going up.
A lot of banks won't even give you a home equity line of credit now.
I remember.
The sad part is not only are those balances going up, but banks are saying we're not going to give you any more. We're not making new loans. So like a friend of mine called me up and was like, "Hey, where can I get a home equity line of credit from?" And I'm like, "Well, who's your first loan with?" He goes, "Wells Fargo." And I go, "You got a problem."
Yeah, they're not going to do it for you.
And he goes, "What do you mean?" I said, "Well, typically speaking, most banks are not going to make a home equity line of credit or a second trust deed loan behind somebody else's first trust deed, depending if you live in a trust deed state or a mortgage state. But yeah.
Right.
And Wells Fargo, who had his first trust deed, aren't making any new HELOCs at all.
Right.
So he's just straight ass out of luck.
Right.
Which is a technical term, by the way.
Yeah.
Ass out of luck.
Ass out of luck.
Yeah.
And a lot of people, I know sometimes you won't be getting them now anytime soon, but how people, I was actually talking to a coworker today about it, and I guess customers are calling in at institutions and asking like, hey, so I think I have a HELOC that I like to draw. I was like, oh no, that was only for 10 years. It doesn't last forever.
Yeah. 10 years, you're out.
Yeah.
Yahtzee. Ball so soft.
But the way they were selling it and pitching it for the last like decade was you should apply for this, keep the balance zero, and use it in case of an emergency.
Yeah, that's true.
Yeah, that's the way it was being sold for the longest time.
And I have a feeling that you're going to see a lot of people
I remember, dude.
get pimp slapped by their lender saying, yeah, we're not going to renew that, so figure it out.
Yeah.
Say goodbye to your 3% first trust deed rate, kids.
Bank's going to call and be like, hey, customer, like to play games? There's a game I like to play. Fuck around and find out. You want to see if I renew this bitch?
That's why you're not a nice person. That's some shit a villain would say. Of course you would think of that.
That's your favorite game. You told me that was your favorite game to play.
Yeah, I did tell you that. So I included this next article solely because I love you, and this is my gift to you. I wanted to take you to a romantic place that I know that you really like to close your eyes and envision.
Come on, bring her.
So the title of this lovely article from Bloomberg Business, once again, Tales from the Crypto Winter. What happens when the prophecy of blockchain fails? ? Fails. So there's a whole video. We're not going to play that. But what we should do is I should give you a nice little 2.5 paragraph taste. No, a little longer, actually. Shit, as long on that. Yeah, okay, a little longer. So Christopher Beam was caught up in the crypto fever in 2021 at the urging of a friend. Was it a friend, Christopher?
It was the fervor, not the fever.
The what?
Fervor.
Okay. You going to be that guy now?
Hey.
Did fervor or fever make a fucking difference in the paragraph?
For me.
Did anybody listen to this shit go, oh my God, did he mean fervor? You piece of shit. You want to big league me, huh? Okay.
Just want to make sure we read it correctly.
I'm about to throw a shoe at you.
This is from Bloomberg Business. I just started subscribing to Bloomberg.
Yeah,
you cost me $150. For the listeners who don't know, Chris goes out of his way to use his corporate Bloomberg account and post articles in our show notes to help me prepare for the show. Little did you know, I don't have a Bloomberg account.
No, I do that on purpose. So whenever you hear Saied go, yeah, what he said, that's because I posted something that he couldn't read about.
So you cost me $150 today, sir.
It's okay. I'm going to switch to the Wall Street Journal next.
I got the Wall Street Journal. I already got the Wall Street Journal.
Oh, okay.
$1 a week.
I'll find something you don't have. Don't worry.
Yeah.
It'd be like the Dallas Morning News or some shit like that, but I'll get you.
Yeah.
After doing my own research, i.e. half listening to a few podcasts set at 2 times speed, he writes for Business Week, I decided to buy some. So you listen to a couple podcasts on 2 times speed, and you're like, you know what? Yeah, now's the time to buy.
Makes sense.
Buy now.
Totally.
The crypto winter has yet to thaw. How are its various tribes coping? Wait a minute.
Can you try again?
Yeah, you moved down the paragraph.
No, I did not.
You did, though. Can you scroll back up so I can see where I was supposed to be starting here?
It's right there.
There we go. After a series of cascading implosions causing... God damn it. He's fucked me up.
After a
Saied,
series
please.
of cascading implosions caused the value of crypto to plummet last year, he had a very different conversation with a friend. Quote, let me issue a blanket apology here. It was the blind leading the blind. Thank God.
Not the colorblind leading the colorblind.
Yeah. I mean... Dude, 8% of all people are colorblind. I'm not like...
Do you get a special parking spot for that?
I should, honestly.
Yeah. Is it like gray?
I should have my own lane because you can't trust me to be reading these street lights.
I don't like the idea that the only way you can tell if you stop at a light is if the top light is on or the bottom light is on.
Yeah.
That's very uncomfortable for me.
Or middle. There's also a middle light.
You never drive me anywhere, for the record. Never.
I'm a very safe driver.
Yeah, you have to be when you're blind.
Okay, I
Colorblind.
drive extra slow. Extra slow.
Yeah.
That's why I got the Jeep.
Finish
But
this.
anyways, the crypto winter has yet to thaw. How are its various tribes coping? Tap the link in the bio. That's what it says.
So essentially, there's this whole script that Arun pulled up, and if you would like to read it, I think it's hilarious.
Okay, let's go. A lot of people who got caught up in crypto have experienced not just a financial loss, but a kind of financial grief, a tangle of guilt.
When you throw your money away and light it on fire, this is what happens.
Right. Second guessing and that awful feeling of having fallen for something. For many, crypto had become an identity, a way to feel smart and subversive and on the cutting edge of new technology. What happens to that self-image when its foundation erodes?
So effectively, that was a really fancy way of saying what happens when you play fuck around and find out.
Yeah. What happens when you trust somebody you shouldn't trust?
Well, the next sentence, Saied.
It's either going to zero or it's going to be the successor to the U.S. dollar.
That
Yeah.
also sounds what most cults say.
Yeah. I mean, come on,
Either
man.
the aliens are coming down or we're going to die. Either way,
Right.
we're going to rise.
The words of Plan B, a Dutch institutional investor turned Bitcoin analyst, captured the attitude amongst some of crypto's double downers. Others keeping the faith describe the crash as a purge that proves crypto must return to its roots. Academics say this type of thinking is consistent with the psychology of both trading and gambling. Yeah, not something I want to do.
If you have to go by an alias called Plan B,
Mm-hmm.
I would not think that you're probably somebody I want to listen to.
Yeah, I mean, Plan B.
You're named after a contraceptive.
Jesus Christ, man! I can't believe people bought this shit. I mean, look, it took a big man of Chamath to admit that, nah, man, this shit it's not happening. Get out. And I think that if you can't see the writing on the wall like that, I mean, what are you doing?
Yeah, I mean, it's also a billionaire who dipped his toe in the pond and said, you know what, not good. So, I mean, he's got a lot more financial
Yeah, but he was
responsibility.
very strong in his opinion about, he was very bullish, if you will.
Yeah, but at the time, it was easy to buy in. I
Mhm.
get it. I went on the path of trying to understand all this and trying to get in and looked at NFTs, and I did all that.
Mm-hmm.
But there's a point where you just, it got comical.
Yeah.
So let's finish this off here with the last couple. I think you'll find these interesting.
Francis Coppola, who
And I really want to hear you say the middle sentence. So take your time.
Francis Coppola, who was cited in the court case against Terra USD's Do Kwon, is part of the community of skeptics who have long pushed back against crypto boosters. Quote, "We did take a lot of abuse from the have fun staying poor crowd," she says.
All right, here you go, everybody. This is the reason that I fumbled the bag reading this, so Saied would have to read this. Give it to me.
Schadenfreude is the right term.
That actually wasn't bad.
Fucking
Fuck,
nailed
God
that.
Damn it.
Yeah. There was a handful of us before screaming into the abyss, says Amy Kasser, another prominent crypto critic. Now there's a lot more. It's very funny to look back and think, were we all just drunk or something? It's funny. I mean, you got to be a billionaire to look back at all this and be like, I lost some money. Fuck it. That shit was funny, wasn't it?
Yeah, I got a Bored Ape, though.
Yeah.
Yeah.
Yeah. I got this cool Bored Ape. Look at this. You could have got that shit off Venice. Go down to Venice Beach. Somebody will draw that shit for you. Across Twitter and Telegram and Discord communities sprang up to discuss beloved assets, share memes, and trash competitors. This was particularly true of NFTs. Their disillusion has left scars, some of them literal. Emma Cruddington got the logo of a hot NFT tattooed on her arm on a whim. She's still involved in another NFT project, spending hours each week talking to other owners. She knows such communities can be exploitative, but says it's different. There's no ulterior motive behind it.
See, reading is fundamental.
Yeah, fucked up on the last sentence.
Yep, it's okay. That's how we're going to end the show, too.
Yeah.
We're going to end it. Although, I have a new name for NFTs.
What
does it stand for? Non-fungible token?
Yeah.
You got any idea what that really means now?
I bet you do.
Not fucking tangible.
Yeah. Good point.
Yeah. Thank you. I'm here all week, kids. Yeah.
Good night, everybody.
Bye! Bye.